Hello and welcome to Chapter 6, Project Evaluation Decision Methods. What this chapter does is to build on previous knowledge and present 6 tools to evaluate projects. 3 of them based on total value, the same is to say absolute value, the same is to say dollar amount that they generate. The other 3 methods fall into the category of relative value methods, that is, return per dollar invested, percentage return. Now, in the total value methods, you already know these tools. You already know how to compute the net present value, also known as present worth, the future value, also known as future worth, and the annual worth, which is basically transform those cash flows into annuities. So there's nothing new there. When it comes to the relative value methods, you already know how to compute the internal rate of return. What is new is the benefit cost ratio, which is basically the ratio of the present value of the benefits divided by the present value of all costs, and the external rate of return. The difference between the internal rate of return and the external rate of return is that the internal rate of return, as you learned before, is the interest rate that makes the net present value equal to 0, whereas the external rate of return is more comprehensive. The internal rate of return suffers from the reinvestment fallacy. What does that mean? It means that it ignores that positive cash flows received throughout the project are not reinvested. It assumes that they are not reinvested, but they may very well be, and that's something that the external rate of return takes into account. In addition, instead of focusing on the net present value as the internal rate of return does, the external rate of return focuses on the future value. To be more precise, what it does is asks us to find the interest rate that makes the future value of all costs equate the future value of all benefits when these benefits are reinvested at the so-called reinvestment rate. You should read the chapter carefully, because one of the valuable things that it shows you is different names for the same tool. So for example, the net present value can also be referred to as present worth and present value. The future value method can be referred as net future value, future worth, and future value. The annual worth method can be referred as annual worth or equivalent uniform annual flow, EUAF, or equivalent uniform annual series, EUAS, or equivalent uniform annual cost, though this term is more commonly used when we're talking about cash flow series where they are predominantly negative cash flows. And this is going to be something we're going to cover in chapter 8. But again, as you can see, several names for the same tool, and I may very well use these alternative names in the quiz and homeworks and exams, so you should know it. Now, the benefit cost ratio is also known as profitability index or savings investment ratio. The internal rate of return is also known as simply the rate of return, ROR, or the discounted cash flow rate of interest, or the discounted cash flow rate of return. The external rate of return presented here in the textbook, fortunately, is just known as the external rate of return. Now, another interesting issue discussed in this chapter is when using the absolute dollar methods, meaning net present value, net future value, and annual worth, how should we tackle projects with different lives, okay, with different maturities? So the annual worth is the most robust method to use in this case. Imagine you are comparing a 3-year project with a 5-year project. In that case, annual worth is the most robust, will give you the right answer when comparing the projects, meaning the one that has the highest annual worth, or in other words, generates the highest annuity, is the best project. However, if you're using the net present value or the net future value to compare projects with different maturities, we need to transform them into equally lived projects. Meaning what? So in this example on page 93, that you should go carefully, they are comparing two projects where one is a 4-year lived project and one is a 5-year lived project. And then shows you that if you don't do the modification to the projects, meaning if you don't turn them into equally lived projects, that you're going to get the wrong assessment. So what you need to do is to transform these projects into two equally lived projects. How? Using the minimum common multiplier across the maturity of the projects. This is a concept you learn most likely in high school, and you should review it, but basically what it is, for example, in this case, the minimum common multiplier between 4 and 5 is 20. That is when the product in the multiplication tables for 4 and the multiplication table for 5 give the same result. So 5 times 4, 20, 4 times 5, 20, so the minimum common multiplier is 20. Meaning that you're going to have to create, for the 40-year project, 5 replicas, so that the 40-year project turns into a 20-year project. The 5-year project, you're going to have to create 4 replicas, so that the 5-year project becomes a 20-year project. One thing to pay attention to is that the last year of the project is year 0 of the next sequence, of the next replica. That's what is shown here. Note that, for example, at year 0 you need to do an investment of 600 for the 40-year project, and then it generates 400 in positive cash flow, then 300, 300, and 250. Then you need to start the second replica of this project. So year 4 becomes year 0 of the next replica. So to this positive cash flow, you need to deduct the investment needed to start the next replica. Remember, year 0, right? So year 0 of the following replica is the last year of the first replica. And then, see, they replicate 400, 300, 300, 250. Start another sequence. And so on, till the last cash flow, which is 250. Here you don't have minus 600 because there is no additional replica needed. We already reached 20 years. For the 5-year project, the same rationale applies. Only 4 replicas are needed, so there's 1, there's 2, there's 3, and there's the 4th replica. To start each replica, you need to invest 400. That's why it shows up there always minus 400. Not in the last one, because no additional replica is needed. So once you transform both projects into equally lived projects, they are both now 20-year projects, you can compute the net present value or the net future value, and the one that shows the highest is the best. So for this 5-year project that we turn into a 20-year project, the net present value is 630. Whereas for the 40-year project that we turn into a 20-year project, the net present value is 690. So this project is better than the other one. This is what you need to do if you are told to use the net present value or the net future value to evaluate which one is the best project among these projects with different maturities. You need to transform them into equally lived projects. However, if you are using the annual worth, you don't need to do this. If you're using the internal rate of return, you don't need to do this. If you're using the benefit cost ratio, you don't need to do this. If you're using the external rate of return, you don't need to do this. You only need to transform projects into two equally lived projects if you are using the net present value or the net future value as a tool. Lastly, this chapter 6 on page 97 also introduces another new method. It's called the payback period method. Now, this method is a naive method. This is to be used only to break up ties, never by itself to select the best project. You only use the payback period method if you have, for example, two projects with the same annual worth. Then you get stuck. Which one is better then, if they have the same annual worth? One way to break up that tie is to use this payback period method. Basically what it does, it ignores the time value of money, meaning it ignores compounding interest, and assesses which one is the best by checking how fast you recover your investment. How do you do that? You basically start adding the cash flows in the project up to the moment you cover all the costs, up to the moment that the summation of the cash flows turns equal to 0. So that's how you select the best project. There is a couple of demonstrations of the payback period. Look at example 5, implementing the payback period. So in year 0, you need to make a $250 investment. In year 1, you need to make an additional investment of $750. And then by year 2, you get another $50 plus 80 cents, meaning you invested $1,000 up to year 1, and now you recovered another 50. So you still have another 49.20 cents to recover. Next year, year 3, you get additional $366.80. So you add the 306 to this negative 849 and you get negative 482. This is the amount that you still have to recover to break even, to recover all your costs. The next year, year 4, you have 519.40 as a benefit, positive cash flow. But you don't need all that money to offset your investment, right? You just need 482 back to get to 0. So what do you do? You basically figure out how much the $482 that you need, how much as a portion are they of the 519 you're going to collect. So they represent 0.93 or 93% of the 519. So we basically say you need 93% of a full year of this year 4 to recover your initial investment. So how long did it take you to recover the investment? Well, 1 year, 2 years, 3 years, 3 full years plus 0.93 of this 4th year. So your answer is 3.93 years as a payback period. Then you would compare this to another project, and the one with the same, for example, annual worth. And you'll check out again how fast would you recover your investment to break even, to reach 0. And if the other project was like 5 years to recover, then this would be the best project because it's faster. The payback period is shorter. Let me remind you again, you only use this simple method. We just adding the cash flows till we reach 0, ignoring interest. So you just use this method to break up ties. And you advocate that the project that allows you to recover your investment faster is the one that should be selected, given that it has the same, for example, annual worth as the other project. The point being, to break up a tie, you select the project that gives you your money back faster. And that's it for chapter 6. The next video is going to show you a couple of exercises.